Good morning, everybody. Good morning. I hope you all are there in the session. Apologies for the late start. There has been no network and no electricity out here, so I couldn't inform you earlier. But let's not waste any time and let's do the questions, right? We'll start with Unit 10 now and we'll start with the questions directly. Good morning. Is my voice clear, everybody? Do let me know. Please do let me know. Is my voice clear to you all? Good morning, everybody. Okay, let's start then. I'll give you a little bit of the gist of the whole unit. Unit 10 is all about capital budgeting, but for international project investment decision. Now, this is important. I will keep it at 4-star rather keeping it at 5-star. It will have theory questions and it will have case study based questions. Okay, whatever we have done till here for capital budgeting, that you keep in mind, plus you have to keep in mind the additional factors in international projects. Let's see, for example, if I give you one example, this is Mr. India and there is one Mr. America or Mr. USA. Mr. India is an importer. He imports from Mr. US. And what will he pay? He will pay money, right? Either he will pay money or he will pay dollars. Usually you pay dollars. Whenever you buy from outside, it depends on the bill. If the bill is in rupees, then the payment has to be in rupees. If the bill is in dollars, then the payment has to be in dollars. Now, let's say Mr. India imported a machine from Mr. US. So, if the bill is in dollars, then Mr. India has to pay in dollars. Let's assume that uh, $1 lakh payment is to be made, and let's assume today's rate is today on the day he's purchasing it. He has to make the payment after 3 months. On the day of purchase, on the day of purchase, the conversion rate is rupee $1 equals to rupees 80. Okay, so the payment is as per 80 rupees today. But let's assume, and how much is he has to total pay? $1 lakh. So 80 into 1 lakh. But let's assume the prices of dollar went up due to the war. The prices have already went up in the past few months. So let's assume that $1 has become 85 now after 3 months. So payment here is lesser, but payment after 3 months will be higher. It will be higher, don't you think? Because of exchange of currency. Because of exchange of currency. So there is always a currency risk involved. What if Mr. India was an exporter? What if Mr. India was an exporter? Could be a possibility, right? Could be a possibility that he's an exporter. Then he must have exported a machine. He would have given a machine, and he would have gotten what? He would have gotten money. And he would have gotten money. He would have gotten the payment, let's say, after 3 months only. Then his money would have the money that he would receive will also depend on the exchange rate, right? Earlier he would have got only 80 rupees. 80 into 1 lakh, but now he is getting 85 into 1 lakh. What if the currency went down? Then his money would have also gone down. So there is always a risk of foreign currency fluctuation, right? There will always be a risk of foreign currency fluctuation. There will be a risk of political risk. What if the political parties of two nations, they have a war? For example, out of nowhere there is a war between uh, UAE is not a participant, but even though they are under a lot of pressure, right? Then you have tax differences. There will be different countries have different tax laws. There will be inflation rate. There will be blocked funds. That my fund is blocked because whenever you are importing or exporting, you have to give LCs. Okay, and some other countries have strict profit repatriation laws. That how much money can you bring back home, and then you have adjusted present value. You apply APV for international project evaluation. This we can take not just for machine but any sort of project as well, right? So assets plus projects. I hope it is making sense to all. Any doubt, anybody, please ask. If there is any sort of doubt, please ask me. Okay, next. Moving ahead, let's do the questions. This is what you wanted to know about this unit. Let's do the questions. An Indian company is evaluating a long-term project in foreign country. The finance team prepares projections in foreign currencies. Then there is a currency risk involved, right? But faces uncertainty due to exchange rate volatility. Differing legal system and integration of foreign and domestic cash flows. The team is also considering the use of forward rates. What are forward rates? You all work in bank, but for just for clarification, what happens is today I make an agreement with the bank that after 3 months, quote me dollar for this rupees, right? So I have made an agreement for with the bank for upcoming time, right? For whenever you will see one thing, I'll let you know. Whenever the foreign rates are quoted, they are quoted like this. This is the bid rate, this is the ask rate. Bid is the bank will buy your dollar at 85 rupees, but it will sell you the same dollar at 85.5 rupees. So that they will buy at 85 and sell at 85.5. So always remember, if you get a question like such, so you know which amount is to be used. Okay. For future transactions and evaluating discount rates for project appraisal. Which of the following statements are correct regarding capital budgeting for international investments? Capital budgeting decisions for foreign projects require consideration of non-financial factors such as political stability and cultural differences. Do you think this is correct? Do you think this is correct? Yes, of course, we have to take care of non-financial aspects as well because they will hugely greatly affect our foreign currency involved. So statement number 1 is correct. Statement number 2, exchange rate volatility can impact projected cash flows and may require scenario analysis. Yes, my cash flow highly is dependent upon the currency, on the exchange rate. So this is also correct. Spot rates. Acha, when I go today to bank and ask for the dollar transaction, this rate that is quoted today, it is known as spot rate, and the rate that they will give me after 3 months is known as future rate, right? Spot rate are always used for future transaction in capital budgeting to eliminate uncertainty. No, forward rates will be used. They are not always used. In the question they have said that they are coming into contract with for forward rates. Integration of foreign and domestic cash flow may be necessary when project benefits are shared across entities. Yes, you will have to integrate foreign and domestic cash flows if more than one entity is involved. Forward rates are influenced by interest rate differential and time to maturity. Yes, correct. Forward rates are highly dependent on the interest rate. And when is the time to maturity? Like if you are getting dollar, you're getting into the forward rate for 1 month, 2 months, 3 months, 4 months, dependent on that. So only 3 was not correct. So A is the correct answer. A is the correct answer. 1 is correct, 2 is correct, 3 is incorrect. 4 is correct, 5 is correct. I hope you all are able to. Very good, Sharad sir. Very good, Shreyansh sir. Shabash, you all are able to do the question. I'm really proud of you. Next question. With reference to international portfolio investment and related regulatory framework, consider the following statements. Under the liberalized remittance scheme, resident individuals in India can remit up to 250,000 USD per financial year for permitted capital and current account transaction, including overseas portfolio investment. So, as per the rules, do you think this is correct? Under the liberalized remittance scheme, resident individuals in India can remit up to $250,000 per financial year. Do you think this is correct? Yes, this is correct. As per the LRS limit, the USD dollar amount is 250,000 only for individuals, as prescribed by RBI for overseas investments. So this is correct. This is as prescribed by RBI for overseas investment. So this is correct. Statement number 2. Investments made under the international portfolio investment must necessarily be denominated and settled in Indian rupees to avoid currency risk exposure. If this was a necessity, then nobody would be afraid of currency risk. So this is wrong. Exchange rate fluctuations are always directly correlated with stock market performance in the foreign country. No, they are not always directly correlated. For example, today we are going through a war which is impacting us. We are not even a participant of this war, right? Hedging through forward contracts can be used to mitigate currency risk arising from overseas investment. Yes, you are trying to hedge yourself. You are afraid that there will be a currency fluctuation. So you are trying to hedge yourself via buying a forward contract. Via buying a forward contract. Okay. Diversification across international markets may improve the return trade off compared to investment only in domestic securities. Correct. If you will diversify yourself by international markets, then yes, risk return trade off will be better. It will be better. So only 2 and 3 are incorrect. Only 2 and 3 are incorrect. So 1, 4 and 5 are correct. D is the correct answer. D is the correct answer. Very good, Sharad sir. Very good, Shreyansh sir. Absolutely correct. Absolutely correct. Next question. Next question. Rohit, a resident individual in India, remits fund under the LRS during 25-26 to invest in foreign securities. He remits $2 lakh when the exchange rate is 93. After 1 year, अब एक साल बाद क्या हुआ? The value of his investment grows by 12% in USD terms. So 12 lakhs plus 12%. The exchange rate moves to 98. Now he has invested somewhere and he will get back what? He will get back dollars now. He has invested in dollars and he is getting back dollars. If he has dollars with himself, first in the initial time he was getting 93. Now he is getting what? 95. And he has invested 2 lakhs. Now instead of 2 lakhs, he is getting 2 lakhs plus 12%. He does not hedge his currency exposure. Okay. Based on the above general financial principle, evaluate the following statement. The initial investment in INR is 1 crore 86 lakhs. Do you think this is correct? The initial investment, it should be 2 lakh. Initial investment should be 2 lakh into 93. 2 lakh into 93. How much is that? All of you take out your calculators. 2 lakhs into 93. 1 crore 86 lakhs. So the statement is correct. The statement is correct. The value of investment after 1 year in USD is USD 224,000. 2,24,000. Let's calculate it. 2 lakh plus 12% of 2 lakhs. 12% of 2 lakh is how much? Or you can simply write 2 lakh into 1.12. Yes, this is also correct. This is also correct. It will be 2.24. The final value of investment is 21,952,000. Let's calculate it. Let's calculate it. 224 into 95. Oh, sorry, into 98. Here also I'll change the example. Into 98. What is your answer? What is your answer? Yes, the answer is correct. 219,520,000. So this is also correct. The overall return in INR term is more than 15%. Let's calculate it. Let's calculate it. I am getting this and I invested this. How do you find out the returns? Outflow minus you have to find out what you are getting. So what is it, the total inflow today minus what was the outflow in the beginning divided by what was the outflow in the beginning. You always compare from the beginning for finding returns. Okay, so 219,520,000 minus 186,000,000 divided by 186,000,000 into 100. This is the amount that you will get. This is the amount you will get, which will be approx 18%. So yes, the answer is correct. The INR has appreciated to 90 rupees instead of depreciating. The INR would have been higher. Do you think this is correct? Now, if the INR had appreciated to 90, instead of going to 98, it came down to 90. So the INR has appreciated, the dollar has depreciated. Instead of depreciating, the INR would have been higher. Now the amount you would receive is higher. No, initially you were getting 98. Instead of 98, you are getting only 90. The amount will decrease. The overall return will decrease. So this is wrong. Only 5 is incorrect. So B is the correct answer. B is the correct answer. 1 is correct, 2 is correct, 3 is correct, 4 is correct, 5 is incorrect. 5 is incorrect. Very good, Sharad sir. Again, Sharad sir is on fire today. Next question. An Indian investor, Raghav, is evaluating international portfolio diversification. He is considering investment through a mix of direct instruments like ADRs and ETFs listed overseas and indirect channels like global mutual funds. He is also analyzing macroeconomic conditions such as tightening monetary policy in the Federal Reserve, geopolitical tension, and fluctuating currency movements between INR and USD. Raghav uses modern art pricing techniques such as CAPM and also explores the multi-factor models like arbitrage pricing theory to assess expected returns and risk across markets. He notices that despite higher returns in certain emerging markets, volatility and regulatory uncertainties remain significant. Which of the following in the context of international portfolio are correct? Investments through ETF in foreign market are classified as indirect international investment when routed via domestic fund houses. So you are making investment via domestic fund house but making payments in ETF. So we all do this, right? We all do this, that we invest via our domestic house but we trade in ETF. Do you think then it will be indirect mode of payment? Yes. Indirect international investment, correct. When you are using a domestic fund house for trading in ETF, it will be indirect international investment. This is correct. Under CAPM, beta measures only unsystematic risk and hence can be diversified away completely. Do you think beta tells you unsystematic risk? It is 1000% wrong. It is telling you systematic. See, what does beta tells you? Beta tells you the market risk involved, which is actually a systematic risk, right? Systematic risk cannot be diversified, right? It is central to CAPM. How can you diversify it? So this is wrong. Under ATP considers multiple macro factors such as inflation and GDP, unlike CAPM, which primarily relies on market risk premium. What is market risk premium? What is market risk premium? First of all, tell me that. My question to you is, before answering you this whether this is correct or not, my question is, what is market risk premium? See, CAPM actually follows one formula, which is risk-free rate of return plus the beta of the market, that is the systematic risk of the market, into the market premium. What is risk premium? What is the market rate minus what is the risk-free rate? What if you had not invested in this particular project and you would have given your money, you would have kept your money in a risk-free security? This is what CAPM tells you. What is CAP? This is what CAPM tells you. So market risk premium is RM minus RF. The return from the market minus risk-free return. This is the risk that you are taking. This is the risk that you have taken. It is then this should be the premium that you should receive. So this is correct. Under APT, various factors are taken into consideration. Currency depreciation of investors' home currency. That for example, for India, rupee, the rupee has depreciated, always increases real returns from foreign investments, irrespective of inflation differentials. Do you think this is correct? Wrong. Wrong. Inflation should be considered. Yes. Depreciation of our own currency. For example, in the previous question, rupee went from 93 to 98. It was depreciated so much. It was increasing our investment, but if the inflation differences are not taken into account, then this is of no use. So this is incorrect. Next. Lastly, FDI is generally considered a direct channel of international investment involving ownership and control. Correct. Correct. So 2 and 4 are not correct. C is the correct answer. C is the correct answer. Were you able to give the answer, all of you? Sharad sir, you did not give the answer this time. I'm waiting for your answer. People over YouTube, please write your answers in the chat box. Please write your answers in the chat box. Okay, next. An investor based in India is evaluating the international equity investments in the US market. Okay. He uses the CAPM to estimate expected returns and adjust it to currency impact. Risk free is itna, risk free in US is itna, expected market return in US is itna, beta of the stock is this much, expected depreciation of INR is 3% per annum, inflation differential is also given you as 2%. Which of the following represents the most appropriate expected return in INR terms? Important. They're asking you for INR for the investor after adjusting the currency movement. See, CAPM has a basic formula of risk-free return plus beta into the market premium, right? But in such, we will use this only. We will use this only. But the question is whether you will use it for US market or you will use it for INR. So, okay. So, what will happen is we will use US market. We will use CAPM on US market since the investment is in US market. Apply the CAPM and find out the expected rate or expected return. Then first you do it for US, then adjust it and get it for India. Calculate it for US, and after adjustment you will get INR. Right? Right? So let's find out. The basic formula is risk free plus beta into risk of the market minus risk free security returns. So what is risk free? Risk free is 4% in US. I have to take for US 4% plus beta is 1.3. Risk return, expected return from the market is 11 and risk free is 4. So 4 plus 1.3 into 7. What will be the answer? What will be the answer? The answer will be 13.1. 13.1. I have to now adjust it for depreciation. So 4.1 now 13 point sorry what was my answer? It was 13.1. Now I have to adjust it for depth. Adjust it for depth. So it will be 13.1 plus 3% because there is a depreciation of INR. So because of depreciation, the Indian rate of return will be different, which will be 16.1. It will be 16.1%. So C is the correct answer. C is the correct answer. I hope you all are able to do the question. Very good, Sharad sir. Shabash. C is the correct answer. I hope you understood what we did. We calculated for the US and then we adjusted it for India. Then we adjusted it for India, right? Next. An Indian multinational company is evaluating a proposal to establish a manufacturing facility in Southeast Asia in 2026 to cater to both local and export markets. The project requires an initial investment in foreign currency. Dollars में करेंगे भाई. The finance team considers factors such as differing global interest rates, volatile exchange rates, geopolitical risk, and involving global taxation norms. They also examine whether to finance the project locally or from India. The company aims to assess project volatility using discounted cash flow techniques while incorporating international financial complexities. Okay. Which of the following statements are correct? The discount rate used for overseas projects must incorporate country risk premium in addition to the global risk-free rate. Do you think this is correct? Do you think this is correct? For now, I have calculated my cash flows. I have to discount them. So the discounting rate should have risk-free plus any currency risk, country risk premium as well. Do you think this is correct? 100% correct. Risk-free return is not sufficient. There is a risk involved, so use that for discounting rate. It should be risk-free plus any risk premium. Any risk premium of that country. So yes. Exchange rate fluctuations can be ignored in the projects if the project generates revenue and cost in the same foreign currency. If the cost and revenue are in the same currency, do you think you can ignore the current exchange rate fluctuation? No. See, this is incorrect. Why? Let's assume my investment, that is the cost, is also in dollars and the revenue that I will get is also in dollars. But my parent company is in India. So I will get dollars, but I have to convert these dollars into rupees always. Why? Because of FEMA rules. FRI rules. You cannot keep more than 2 lakh rupees in terms of dollars. So maximum dollars that you can keep for yourself is when you can convert them for 2 lakh rupees maximum. So you cannot keep dollars freely with yourself. You have to get them exchanged. So this is wrong. Global minimum tax frameworks such as OECD-led initiatives may affect post-tax cash flows for international projects. Do you think this is correct? Yes, correct. Yes, correct. Because of OECD, international taxation cash flow will be affected by tax implication, and we will have post cash flow of international projects. Political and sovereign risk are irrelevant if the host company has historically stable growth rate. Economic growth, no. Anything can happen anytime. So no, this is not correct. Financing decisions, local or parent country funding can influence both project risk and cost of capital. Yes. Whether I want to sources locally or I want to go international, it will increase or decrease my project risk and cost of capital. So 2 and 4 are incorrect. So B is the correct answer. B is the correct answer. B is the correct answer. Are you all able to do it with me? Okay. B is the correct answer. Very good, all of you. So what we're going to do is I'll take a 3 minutes break and then I'll be back. 3-4 minutes break I'll take and I will be back. Yes, sir. Do you have anything to say, Shyam sir? Okay. I think that was my mistake. So just give me 3 minutes. I'll be back. Okay, yes, I am back. Okay, let's start again. Next question, please. An Indian company is evaluating a project in Europe. The project requires an initial investment of 2 million euros. Expected cash flow is 600,000 per year for 5 years. So the initial outflow today itself is this much, but you are getting only and only 600,000 for 5 years as cash flow. Spot exchange rate for today is itna. That means you are giving out itna today, right? Expected annual depreciation of euro is 2%. Okay. Required rate of return, that is the discounting rate, is 10% in INR terms. The company converts all future euros into INR before discounting. Okay, makes sense. The year one expected exchange rate will be approximately 88.2. Based on the above information, which of the following statements are correct? That year one expected exchange rate will be approx 88.2 per euro. Do you think this is correct? We can calculate it because there is an annual depreciation for 2%. So 90 minus 2%. 90 minus 2%. How much will it be? Please tell me in the chat box. 90 minus 2%. How much will it be? Or 90 into 0.98. Simply you can find that. Yes, it will be 88.2. How do you find this out? 90 minus 0.02 or 90 into 98, right? It will give you the same answer, 88.2.98. Okay. The value of INR first year cash flow will be approximately 5.29 CR. We can calculate that. We are getting 600,000 and the rate is 88.2. So how much will it be? How much will it be? 6 into 88.2, which is actually approx 5.29 CR. So this statement is also correct. If exchange rate depreciation is ignored, the project's NPV will be overstated. If you do not take care of depreciation, then will NPV be higher? Yes, artificially it will be higher because you did not take care of debt. You will assume that exchange rate is again 90 only and you will keep booking your inflows at 90 only, which is wrong, right? So this is correct. The present value will be less than 4.81. Let's calculate the present value. 5.29 divided by 1.11 for the first year. For the first year, right? Because 10% is the discount rate. So, sorry, not 1 1, it will be 1 0. 10% is the discount rate. So, 1.10. So, because future value divided by 1 plus r power n, right? So, 5.29 divided by 1.10 power 1. Yes, it will be less than 4.81. It will be around somewhere 4 point. Yes, this is correct. Lastly, the exchange rate risk affects only the initial investment and not future cash flows. This we have just estimated that my future cash flows are impacted. So this is wrong. This is wrong. So only fifth was incorrect. So D is the correct answer. D is the correct answer. I need answers from you all in the chat box, please. D is the correct answer. Next question. How many did you calculate? Ma'am, how did you okay. Got it, Shreyansh sir? I just calculated future value divided by 1 plus r power n. So, future value is 5.29. divided by 1 plus 0.10 power 1, which is 5.29 divided by 1.10 power 1, which is 4.81, right? It is actually 4.80. That is why we are saying. Okay, next question. Next question, everybody. The next question is, an Indian company is evaluating a US based project. Initial investment is this much, and where the spot rate was this. Project life is only 2 years, and the expected cash flows are this, and the expected EDs are also given to you. Risk adjusted discount rates for India and US are also given to you. Using both home currency approach and foreign currency approach, which of the following statements are not correct? Okay. Under home currency approach, NPV is 31.6 million. It is very simple. Calculate everything in rupees and then see whether your NPV is 31.6 or not. Okay. Initially, my outflow is, this is home currency, this is foreign currency. Outflow will be 5 million into 83. For foreign currency, it will be 5 million only. Your inflow will be, your inflow for home currency will be 3 into 85 and 3.5 into 88, and you will get your amount, and the discount you have to calculate the discounting rate. You have to calculate the present values. Discount rate will be 12%, right? For your inflows for foreign currency, it will be 3 and 3.5, and the discounting rate will be 8%. And discounting rate will be 8%. Under home currency, the NPV, let's calculate it. Let's calculate the home currency amounts. Year 1 will be 3 into 85, which is 255. Year 2 will be 3.5 into 88, which is 308, right? So the total will be 255 divided by 1.12 and 3.08 divided by 1.12 power 2. So total present value will be around 473. It will be around, the present after discounting, the present value will be 423 of inflows, and the outflow was 5 million into 83, which will be approx how much? 415. So outflow minus inflow, or inflow minus outflow, it will be not 31. See, 423 minus 415, will it be 31? Wrong. This is wrong. 473, sorry, not 4. This will be 473, not 423. It will be 473, and 473 minus 415 is also not 31 but 41. So yes, this is wrong. Under foreign currency, NP will be 29.5. Do you think this is correct? Let's calculate it. For the first year, the present value will be 3 divided by 1.08, right? Present value will be how much? 3 divided by 1.08 power 1, 3.5 divided by 1.08 power 2, and you will get your present values. That will be your inflow, and for your this is your outflow. So 5 minus the inflow will not be equal to 29.5. So this is also incorrect. The difference in NPVs arise primarily due to inconsistency in discount rate used across different countries. Do you think this is correct? Yes, this is correct. The mismatch is due to exchange rate assumption and discount rate. So this is correct. If international Fisher effects hold perfectly, both approaches should yield approximately the same NPV. Yes, because of purchasing power parity, if we take that Fisher effect is holding perfectly, then both should yield you the same NPV. Correct. Under FCA, discounting is done using Indian discount rate and then converted into USD. Wrong. This is wrong. You calculate in USD and then the discounting rate is also of USD only. You use foreign discount rate and not Indian rates. Okay. So this is wrong. So 1, 2 and 5 are incorrect. So B is the correct answer. B is the correct answer. Any doubt, anybody? Any doubt, anybody? Please ask. These are good questions that we are doing. Any doubt that you have, please ask me. People over YouTube as well, if you have any doubt, please ask. Okay, next. An Indian multinational company headquartered in Mumbai is evaluating a long-term investment project in Brazil. The project generates cash flow in Brazilian real, that is BRL, while the parent company reports in INR. Okay. The finance team decides to evaluate the project using home currency approach. Convert everything in home currency and use Indian currency discount rates. They estimate future spot rates using interest rate parity assumption and convert all foreign currency cash flow into INR. The domestic risk adjusted discount rate incorporates inflation differential, sovereign risk premium, and global monetary tightening trends observed post COVID-19. Additionally, the company is considering multiple cash capital budgeting techniques such as payback period, NPV, IRR, and profitability index, while also factoring in exchange rate volatility and cross-border capital flow restrictions. With respect to the above, modern international capital budgeting practices evaluate the following statements. The home currency approach eliminates exchange rate risk completely since all cash flows are converted into domestic rate before evaluation. Do you think this is correct? Do you think this is correct? Incorrect. You are only translating it. How are you eliminating the risk? सिर्फ आपने convert ही तो करा है home currency में. The risk is still there. So this is wrong. Statement number 1 is incorrect. Statement number 2. Under the NPV method, discounting is done using a domestic discount rate that reflects country risk, inflation differential, and global inflation indices. Correct. This is correct. Statement number 2 is correct. Statement number 3. The formula ST is equal to SO is derived from the concept of purchasing power parity and is always accurate in real world. Wrong. It is never accurate. We have to find out if it is holding true or not. PI under home currency may change if exchange rate expectations are revised. Correct. If my exchange rate expectation is different, then PI will also be revised. Global financing tightening cycle can indirectly impact project valuation under home currency approach. Correct. So only 1 and 3 are not correct. So B is the correct answer. B is the correct answer. 1 and 3 are incorrect. Any doubt, anybody? If you have any doubt, please ask. If anybody has any doubt, please ask. Okay, moving ahead. An Indian multinational based in Gurgaon is evaluating a mining project in Australia. Okay, so India and Australia. The project generates cash flow in AUDs. Okay. The finance team adopts the foreign currency approach for capital budgeting. They estimate a foreign currency risk-adjusted discount rate by incorporating the local risk rate, risk-free, and project-specific risk premium. The team first evaluates the project entirely in AUD and later converts the result to INR using the current spot exchange rate. The company also considers global macro developments as inflationary pressure, commodity price cycle, and policy rates change by institutions like RBA. Which of the following scenario and contemporary international finance practices, which of the following are correct? Under FCA, exchange rate risk is ignored during project evaluation since all calculations are done in foreign currency. Do you think that is correct? We have done all the calculations in foreign currency, so exchange rate is not a big portion here. No, it is only deferred. You're not exchange, you are completely not eliminating it, you are not ignoring it, only there is a deferment. We will do it, but after some time, not right away. So yes, this is wrong. Statement number 1 is incorrect. The risk adjusted discount rate in foreign currency incorporates both foreign risk free and a project specific risk premium. Correct. We have taken into account both the things, risk free also and the risk premium also. In NPV method, conversion into home currency is done before discounting. Wrong. It is done after discounting. The acceptability criteria under IRR method compares the project IRR in foreign currency with the foreign currency risk adjusted discount rate. Correct. Even under the foreign currency approach, fluctuation in current spot rate at the time of conversion can influence the final NPV in home currency. Correct. So 2 and 3 are incorrect. So C is the correct answer. C is the correct answer. 1 and 3 are incorrect. Oh, sorry, 1 and 3 are incorrect. D is the correct answer. I did not see that 3 is given here. So D is the correct answer. D is the correct answer. 2, 4 and 5 are correct. 4 and 5 are correct. Do you have any doubt? Is there any sort of doubt? Next. A multinational enterprise headquartered in Europe is evaluating its expansion into Asia. Okay. It plans to route a significant portion of its intra-group transaction through a subsidiary located in low-tax jurisdiction. The management believes the structure will legally minimize global tax. However, recent global developments would indicate increased scrutiny of such arrangements, particularly with evolving international tax framework and stricter compliance requirement across jurisdiction. The BEPS initiative led by OECD has resulted in stricter transfer pricing documentation requirement across most major economies. Do you think this is correct? Yes, this is correct. TP rules are applicable only when transactions occur between unrelated party across different countries. No, TP is for everybody. TP is for everybody, not just unrelated transactions. This is wrong. For my own branch also, I will apply TP, right? Many countries, including India, have implemented country-by-country reporting (CBCR) by enhancing transparency in multinational profit allocation. Correct? The introduction of a global minimum tax under Pillar 2 aims to reduce the attractiveness of shifting profit to tax havens. Correct? Transfer pricing adjustments can lead to only tax penalties but also secondary adjustments such as deemed dividends or loans. Correct? So 2 was incorrect. B is the correct answer. B is the correct answer. Any doubt? Anybody? Please ask. If you have any sort of doubt, you can ask me right away. Is there any sort of doubt? Please ask. Okay, so this was all about unit number 10. Let's move to the next unit that we have. This was all about this unit. So what we can do is let's move to the next unit now. Any doubt in unit 10? Anybody, please ask. If anybody has any sort of doubt, you can ask me right away. Let's move to the next unit. If there are no doubts, then we can move to the next unit. Okay. I hope the screen is visible to all. Next unit that we are starting is unit 11, which is, I will again give it 5 stars because it is very, very important for theory. It is adjustment of risk and uncertainty in capital budgeting decisions. Risk versus uncertainty. First, understand what is risk. Something which I know will probably happen. So this is a risk. There is a risk of exchange rate. We are aware that this might happen. The probability is known. But what is uncertainty? Something that we are not aware of. The probability of which is unknown to us. That by which, what is the probability that this will happen or will not happen is unclear. So that is why it is uncertainty. Methods, we always adjust for risk and uncertainty, both the things. Methods of risk adjustment is risk adjusted discount rate, known as RADR. It increases the discount rate for risky projects. Higher the risk, higher the discount rate. We know that, right? So higher risk will always give you higher discount rate because then your cash flows will decrease, right? Certainty equivalent method. The second method that we will use for risk adjustment is certainty equivalent method. Risky cash flows converted into certain cash flows. This is known as certainty equivalent method. We are trying to make them certain cash flows. Third you have is sensitivity analysis. It changes one variable at a time. So whenever you have more than one variable, you have multiple variable. So one variable is changed at a time. For example, sales, cost, price. Then you have is scenario analysis. Very important. Both of these are actually very important for theory purpose. What is scenario analysis? Multiple variables change together. Best case, normal case, worst case, right? So multiple variables are changed together. Then you have decision tree analysis. What is the useful? It is useful for sequential decisions. This is one of the most important concepts for your exam. So they ask you, decision tree analysis is used where? When you have multiple options with you. So what will you do first and what will be the sequence of it, right? Sensitivity analysis and scenario analysis, I have told you, when you have one variable changing of one variable at a time, it is sensitivity. When you have multiple outcomes, it is scenario. Question number 1. A manufacturing company is evaluating a proposal to establish a new industrial unit for producing specialty packaging material. The project involves imported machinery, large working capital, and expansion into export market. The management is concerned about multiple uncertainties such as fluctuation in demand, environment compliance cost, exchange rate volatility, and possible changes in the government regulations. During project appraisal, the finance team conducts a detailed review to identify variables that may significantly affect the viability of the project. Different scenarios related to sales volume, operating cost, and raw material prices are also examined before making the investment decision. Based on the above situation, examine the following statements regarding capital budgeting risk and Sensitivity analysis. Sensitivity analysis primarily evaluate the effect of change in key variables on project indicators such as NPV and IRR. What are the key variables? Yes, sales, cost, prices. Yes, of course, these are the sales variable. These are key variables. But do you think this will affect my answer? Yes, it will. My NPV and IRR will be impacted. So yes, sensitivity analysis have important variable which are in variation, and they will affect NPV and IRR. So one is correct. One is correct. Sorry. Oh, I'm so sorry. I've given you the answer directly. Exchange risk may arise when a project expands into international market or depends upon foreign sourcing. Correct. Project specific risk can emerge in projects involving hazardous chemicals, political unstable regions, and advanced technology. Yes, it is project specific risk. Correct. Sensitivity analysis require simultaneous alteration of all project variables. Wrong. This is sensitivity. This is scenario and not sensitivity. Marketing risk may increase when the business expands operations from local to national or international. Correct. So only 4 was incorrect. So C is the correct answer. C is the correct answer. Next question, please, all of you. I'm taking you to the next question. Next question is, a company is evaluating a capital investment project requiring an initial outlay of 40 lakh rupees. Okay. The estimated annual cash flows are expected to continue for 5 years. Okay. The finance manager has identified 3 critical variables affecting the project's NPV: annual sales volume, variable cost, and selling price. Yes, this will change, of course. The base estimates are given to you. Okay. The management conducts sensitivity analysis and estimates the following impacts independently. A 10% decrease in sales volume reduces the annual contribution proportionately. Okay. A 20 rupees increase in variable cost per unit reduces annual cash inflow accordingly. Makes sense. A 5% decrease in sales price affects annual contribution directly. Yes, makes sense. Based on the above information, which of the following option is correct? Under base estimates, that is this, annual contribution before fixed cost is 36 lakhs. Let's calculate 20,000 units. Okay, selling price is 500 minus variable cost is 320. So it will be how much? 180 into 20,000, which will be 36 lakhs. So this is correct. This is correct. Sales price minus variable cost into units. Next, under base estimates, annual net cash inflow is 24 lakhs. This is my contribution minus your fixed cost, which is 12 lakhs. 36 minus 12 is 24 lakhs. Do you think this is annual net cash inflow? Do you think this is the correct answer? Yes, correct. Net annual cash, because nothing else is given to us. So this is correct. This is correct. The project's base NPV is approximately 50. Okay. So let's calculate it into present value. This is my fixed annual cost. For 5 years, they have given you PAAF. They have given you PAF, they have given you the annuity value of 3.791. Since every year the amount will be same, they have given you the annual annuity, the combined annuity factor. So it will be 24 lakhs into 3.791. That is your total inflow initial for the total 5 years. So 24 lakhs into 3.7 will be around 90 lakhs, 90.98. So NPV will be 90.98, and your outflow was how much? Your outflow was 40 lakhs. So it will be 50.98. So yeah, this is correct. This is correct. 24 lakhs you're getting for the first year, and if I multiply it by combined annuity factor, that is into 3.79, it will give you 90.98. Somebody might be having this question in their mind, why not multiply it by 5? Because annuity already has 24 lakhs 5 times, so don't worry. A 20 rupees increase in variable cost per unit reduces the annual contribution by 4 lakh rupees. Okay, let's see. 500 minus increase in variable cost by 20 rupees. So it will be 340. So it is 160. 160 into 20,000 will be how much? It will be 32 lakhs. Minus 12 lakhs is your fixed cost, so 20 lakhs. So 4 lakhs, yes, 4 lakhs reduction is there, correct? The NPV is the the contribution is also decreased by 4 lakhs, and net annual is also decreased by 4 lakhs. Correct answer. A 10% decrease in sales volume reduces annual contribution by 3.6. Okay, let's do it. 500, that is 180. 180 into 10% decrease in volume. So 18,000. 18,000, right? So this is also correct. This is also correct. All 5 are correct. So D is the correct answer. D is the correct answer. 10% of 36 lakh is 3.6 lakhs, right? 3.6 lakhs is reduced. So this is also correct. Answer number D. Option number D is the correct answer. Any doubt, anybody? If you have any question, please ask me. Anybody has any doubt, any question to ask, please ask. This is comparatively easier since we have done the major calculation portion yesterday. So it is comparatively easier for you to estimate. Next. A manufacturing company is evaluating a long-term automation project. The finance team prepares 3 possible business environments: stable, rapid, and severe. Under each environment, assumptions regarding sales volume, operating cost, salvage value, and working capital are altered simultaneously. Scenario. This is scenario change. During the board meeting, another analyst separately evaluates the project risk by examining the variability of annual cash inflows and notes that the cash inflow in different years may either move together or independently depending on market conditions. Which of the following are correct? Scenario analysis considers simultaneous change in multiple variables under different conditions. Do you think this is correct? Yes, 100%. That is the basic definition of scenario. This is the basic definition of scenario. Sensitivity analysis generally change only one variable at a time while keeping others constant. Correct. In Hiller's model, lower standard deviation of cash inflow indicates lower investment risk. See, lower standard deviation is actually lower risk only. So yes, this is correct. This is correct. Perfect correlation, that is +1 or -1, among cash projects means cash inflow of different years behave independently of one another. Wrong. They're perfectly correlated. That means there is dependency. So this is wrong. Hiller's model evaluates project risk using NPV. Correct. So only 4 is incorrect. So A is the correct answer. A is the correct answer. Anybody facing any difficulty, then please ask. If anybody is facing any sort of difficulty, please ask me. Ramesh sir, Divan sir, Kastuba ma'am, Sharad sir, Shan sir, any doubts, please ask. People over YouTube, any doubts, please ask. A renewable energy company is considering a solar infrastructure project requiring an initial investment of 12 lakh rupees. Okay. The project has an expected life of 3 years. Okay. The expected annual inflows and their standard deviations are given to us. Risk-free rate is 10%. The finance head wants to estimate the standard deviation of NPV under Hiller model, assuming uncorrelated cash flows. Based on the above data, which of the following is correct? Present value factor for year 2 at 10% is approximately 0.8264. See, that is why I told you the usage of calculator is important. So how do you use calci? Again, I will tell you. For using discounting value factors for first year, second year, third year, fourth year, and so on. 1 divided by 1.10 press equals to, in fact, even if you'll not, 1.10 will give you the first case scenario. Press equals to again, and you will get the answer. You will get the answer. But you press equals to once, you get only first year discount rate. Press it twice, thrice, and 4 times, depending on which year you want to go to. When you have pressed 1 divided by 1.10 and you press equals to, then you will get the PVF factor for the first year. You press equals to again, that is the total equals to is 2. You will get the second year factor. When you press it 3 times, third year factor. When you press it 4 times, 4 year factor. So 1 divided by 1.10, press on the calculator equals to once, you will get the first year factor. Press equals to again, you will get the second year factor. Do you think, are you able to do it? Are you able to do it? So 1 divided by 1.10 power 2, which is actually 0.8264. So this is correct. So this is correct. Variance contribution for year 1 is approx 1322,314,050. Let's calculate it. Let's calculate it. For year 1, you are getting how much amount? You are getting variance contribution. So standard deviation is 40,000. The variance will be how much? The variance will be how much square of standard deviation? So 40,000 square, 60,000 square, and 80,000 square. So for the first year, my variance will be 40,000 square into, that is my variance contribution, and for cash flows it will be how much? For cash flow it will be you have to compute the present value also of it. You have to compute the present value of it. So it will be around 13.22, which is correct. So this is correct. Use your calculators, and you will get it. Use your calculators and you will get it, all of you. Any doubt, anybody here, please ask, because this is important question. This is an important question. If you have a doubt, please ask. If you have a doubt, please ask me. This is an important question. I'm waiting for your answers, you all. Any doubt till here? Chalo. Then moving ahead, if there is no doubt till here, next. Next point says standard deviation of NPV is approximately 93,000. Do you think that is correct? Do you think this is correct? This is incorrect. Standard deviation for NPV will be, first of all, let's find out the variance for NPV. So it is 40,000 divided by 1.10, 40,000 square divided by 1.10 square plus 60,000 square divided by 1.10 power 4 plus 80,000 square divided by 1.10 power 6, right? Which will be around 7393, right? So standard deviation will be under root of it, which will be around 85,987. So this is wrong. This is wrong. See, understand. I know the variance formula. Variance formula for NPV will be square of the variance, variance of the cash flows divided by the discounting rate square for the first year, 4 times for second year, 6 times for third year, right? I know I will be able to find my variance for multiple years. So if I have to find out the standard deviation, so I will just simply, the sum that I have got here, I am naming this as A. So the sum that I have got here, I will take a under root of it, which is not equals to 93,000. So the answer is different. So the correct option is incorrect. So the correct option is incorrect. Always understand the discounting factor has to be in squares for Hiller's model. For Hiller's model, please understand the discounting factor. The year rate will be 2t and not 1t. The answer is 2t. All the formula in itself has 2 power t, right? The form for Hiller's model, the formula has 2 power t. Same discounting factor thing, everything is same except for like till here we have done future value divided by 1 plus r power t, right? Or 1 plus r power n, right? But for Hiller it is 2n. For Hiller it is 2n, and instead of NPV we have square the square of standard deviation, the variance amount. So variance amount divided by 1 plus r power 2n. It will always be 2n. Always be 2n for each year. 2n, 2 into n. So 2 into first, 2, 2 into 2, 4, 2 into 3, 6. First year, second year, and third year. That is why 6, 4, and 2. Always remember this for Hiller's model. For Hiller's model, it is 2n always, always, always remember that. Okay. Now, next. If the cash flows were perfectly correlated instead of uncorrelated, the standard deviation would be lower. Do you think this is correct? Do you think this is correct? This is also incorrect. See, if it was perfectly correlated, the overall projected risk would be higher, okay, as compared to uncorrelated flows. The NPV would have been higher if they were perfectly correlated. So this is also incorrect. Under Hiller's model, discounting or standard deviation is done using squared discounting factor. Correct. Correct. While computing variance of NPV, square of standard deviation. So that is why 40,000 square. So 3 and 4 are incorrect. 3 and 4 are incorrect. So A is the correct answer. A is the correct answer. See, always remember, I will write it here as well. I will write it here as well. That the formula is variance of NPV will be square of standard deviation divided by divided by 1 plus r power 2 into n. 2 into n. Remember this, please. Important for exam because they might ask you the Hiller formula. Next question. Next question. Anybody has any doubts here? People over YouTube also. Next question. A manufacturing company is evaluating 3 alternative automation projects. The finance team has prepared projected cash flow and estimated NPVs under normal market. However, the management is concerned that fluctuation is in electricity tariff, raw material, labor, and export may significantly affect project viability. The analysts therefore decide to repeatedly generate different market scenarios. So this is scenario analysis basically. During discussion, some executives argue that the techniques can entirely eliminate managerial judgment, while others question that interdependence among variables may distort the result if ignored. Which of the following regarding simulation? Because computer-based models were made, so simulation are correct. Simulation analysis generally involve a repeated generation of outcomes under varying assumptions to study the probability distribution of a projected return. Do you think this is correct? Yes, this is correct. What we are trying to do is we are trying to convert a simulation to create a simulation by having repeatedly generating possible outcomes of different uncertain values, right? So that we can have the best results. So this is correct. Next. Exogenous variables are always controllable by project management and can be altered. This is incorrect. This is incorrect. Exogenous variables are not okay. Understand that these variables are determined outside the model and they are generally beyond the control, right? Because they are outside the model, that is why they are uncontrollable. Simulation analysis is particularly useful in handling projects involving multiple interrelated variables and complex scenarios. This is also correct. This is also correct. Next. Even highly sophisticated simulation model cannot completely substitute the managerial judgment. Correct. Even if you have the best simulations with you, the managerial judgment is to be involved, of course. Incorrect treatment of correlation among variables may lead to misleading conclusions. Correct. Correct. So only 2 was incorrect. So B is the correct answer. B is the correct answer. Next question, please. Any doubt, anybody? Next question. A manufacturing company was evaluating whether to establish a new automated production unit for electric vehicle parts. The management team identified multiple uncertainties such as fluctuation in raw material, delay in regulatory approval, and the possibility of outsourcing certain operations. The finance department prepared alternative strategies paths with varying expected cash flows and associated probabilities. During board discussions, some executives agreed that only the most profitable outcomes should be considered, while others emphasized evaluating weighted outcomes and revisiting decisions at every uncertain stage of the project life cycle with the reference of decision tree analysis and related evaluation concepts examine. In a decision tree, a branch represents an alternative course of action. This is correct. See, this is my scenario. This can happen or this can happen. So this both of them have alternative course of actions. While a node represents the outcome. So scenario A, scenario B, these are the nodes. So these are the outcomes. Along with associated probabilities. Do you think this is correct? Do you think this is correct? Yes, this is correct. Every node will tell you what is the probable outcome. So this is correct. So this is the branch, scenario 1, scenario 2, and these are the nodes. B and C are the nodes. This is correct. Decision tree analysis becomes unnecessary when uncertainties arises after the initial investment decision has already taken place. Am I not allowed to change my answer if there is a change in scenario? Of course, I can change my answer. So this is wrong. Decision tree is it becomes more relevant. In fact, evaluation of a decision tree generally proceeds backwards from final outcomes towards the starting point. Okay, let's say this was node B, then I have two outcomes. This all right. This is what was happening. This is what was happening, and then from here I selected 1 2 3. I selected maybe this, right? So I will go back. Where did I get this answer? Okay, I got it from B. From which scenario? From the first scenario. So you are moving backwards. Do you think this is correct? Do you think this is correct? Yes, this is correct. See, I'll make the tree for you again. How the tree is made. The decision tree is made like this. Sorry. Now this is node A. I can have two outcomes, node B and node C. Scenario number 1, scenario number 2. This is known as the branch. Okay, and these are the nodes. From B also you can get two answers. From C also you can get two answers. D, E and F. Right? Higher probability of B will give you D and the lower probability of B will give you E. Higher probability of C will give you E and lower probability of C will give you F. So 3, 4, 5 and 6. Okay. So maybe the best for me is D. Best for me is node D. So I will go back that how did I come to node D? So from scenario 3 of node B, I got D. And how did I get B? From scenario 1 of node A. So my correct answer is A, scenario 1 B, scenario 3 D. So I'm going backwards. So yes, this is correct. Expected values in decision tree analysis are determined by combining outcomes with their respective probabilities. Yes. Do you think this is correct? Do you think this is correct? Yes, correct. Because each outcome has a probability. Higher probability, lower probability. So yes, this is correct. This is also correct. Decision tree analysis requires management to include every possible uncertain, irrespective of project size and materiality. No, this is incorrect. It has to be taken into account. So 2 and 5 are incorrect. So A is the correct answer. A is the correct answer. A diversified manufacturing company engaged primarily in consumer appliances is evaluating a proposal to establish a lithium battery for electric mobility products. The finance team observes that the proposed project has higher volatility. Just one second. It has higher volatility in expected returns compared to company's existing business. However, the strategy division believes that the new venture may complement future product lines and reduce dependence on cyclical appliance demand. Some institutional shareholders have expressed concerns that the company is entering an unfamiliar segment where established competitors already dominate. The board is also examining whether the project could dilute the company's existing brand identity and strain managerial resources. Which of the following are correct regarding corporate risk analysis? A project that appears risky on a standalone basis may still improve the overall corporate risk profile if the complements existing operation. If it complements existing operation, see, it is saying that on my own I am very risky, but overall corporate risk profile will improve since it is a good match for existing operation. Do you think this is correct? Do you think this is correct? Yes. Yes, individually I might be risky, but I will strengthen the overall portfolio because I am reducing the dependency on only just existing operations. So this is correct. Diversification automatically reduces shareholder dissatisfaction. This is incorrect. No, this is incorrect. Shareholders may not always support diversification, right? People want to, the shareholders, they want to individually diversify their portfolio. They do not want the company to diversify. So, second is incorrect. Third, corporate risk analysis consider the effect of a new project on the combined risk profile. Correct. Evaluation of a new project may include factors such as availability of expertise, outside outsourcing costs, competition. Correct. Backward integration or captive facility should always be assessed independently from the overall business structure to avoid distorted evaluation. This is incorrect. They should not always be evaluated individually or independently. Okay, because their strategic value is viewed on conjunction only, right? So this is wrong. This is the wrong. 2 and 5 are wrong. So 1, 3 and 4 are only correct. Is the correct answer. Next. A consumer electronics company experienced rapid growth after launching a smart wearable product. Any doubt anybody till here? Please ask me. I'm here to solve your questions only. If you have any doubts, please ask. So what I will complete it over here. We will complete the whole module today. If you wish, if you have to go to the office, then please, you can, the last portion you can view as the recorded portion, right? Encouraged by initial demand, the management decided to set up an additional manufacturing unit through heavy bank borrowings. At the same time, the company shifted from permanent workers to contract staffing and entered into long-term agreements with overseas suppliers for critical semiconductor inputs. Within a year, a global technology shift reduced demand for Orion existing products. Foreign suppliers revised price sharply upward due to international shortage, while a cyber attack temporarily disrupted the company's procurement system. The board then considered forming strategic partnership with software firms and purchasing derivative contracts to hedge against commodity price fluctuation. A separate risk management division was also proposed to monitor financial exposure, insurance, and contingency. Which of the following statements regarding risk management strategies are correct? Excessive dependence on debt financing may adversely affect profitability and financial stability, even if expansion initially increases the production capacity. Do you think this is correct? Yes, correct. Of course, it is correct. High dependency just on debt will lead to a lot of uncertainties. Long-term supply chain arrangement can help reduce uncertainty arising from volatile international commodity prices and sourcing dispute. Yes, you should have a good supply chain arrangement. The uncertainty will reduce to a certain level. Derivative instruments such as options are entirely risk-free tools. Wrong. They are the most risky. Sequential investment decision may become risky if market demand changes. Correct. Contingency planning involves preparing predefined actions plans and assigning responsibility to reduce the impact of adverse events. Correct. So only third was not correct. So C is the correct answer. C is the correct answer. A diversified manufacturing company is evaluating a proposal to establish a lithium battery. In rapidly evolving technology market, the project requires substantial upfront investment and is exposed to uncertainties relating to raw material, technology, environment, and competitor. The finance committee noted that while the project's estimated IRR exceeds the company's current weighted average cost of capital, the management reverse divided regarding the project's long-term risk exposure. Some directors prefer methods that recover investment quickly, while others believe that risk should be incorporated into valuation models differently depending on project characteristics and managerial risk perception. Based on the above situation, which of the following statements are correct? Under the payback period approach, projects with shorter recovery period may be preferred because uncertainty generally increases over time. Of course, payback period, we select payback period with shorter time periods. So this is correct. In the risk adjusted discount rate approach, the adjustment for project specific differential risk may either increase or decrease the discount rate depending upon comparison with firm's existing risk profile. This is also correct. Project specific risk I will see and then I will adjust accordingly. So this is also correct. The uncertainty equivalent method. The certainty equivalent method assumes that the project risk rises uniformly every year throughout the project life. Wrong. This method does not presume that risk increases at constant rate. Okay, this is wrong. Under the certainty equivalent method, expected risky cash flows are converted into more certain cash flows before discounting them at risk-free rate. Correct. One limitation is that estimation of project-specific risk adjustment may become subjective and arbitrary. Correct. These are very subjective answers, so D is the correct answer. A renewable energy company is evaluating a risky expansion project requiring an initial investment of 12 lakhs. The expected after cash inflows for the first year are uncertain. The finance manager estimates that there is a 50% probability of receiving 4 lakh and 50% probability of receiving 6 lakhs. Okay. A 50% probability of 4 lakhs and a 50% probability of 6 lakhs. High probability, lower probability. However, the management is willing to treat 4,50,000 as certain equivalent cash flow for first year. They have taken 4.5 as certain. Okay. The risk-free rate of return is 8%. Based on the above information, which of the following statements are correct? The expected cash inflow for year 1 is 5 lakhs. Neither 4 lakhs nor 6 lakhs but 5 lakhs. Do you think this is correct? Yes. 4 lakhs into 0.5 plus 6 lakhs into 0.5 is 5 lakhs only. So this is correct. So 6 into 0.5 is plus 4 into 0.5, which is equals to 5 lakhs. The certainty equivalent coefficient for the year is 0.90. Now this is important. How did we calculate it? So certain cash flow divided by expected cash flow. The formula that you will use is certain divided by expected. Certain is how much? 4.5. Expected is how much? 5. So 4.5 divided by 5, which is 0.9. So this is correct. Under the certainty equivalent method, the certainty adjusted cash flow is discounted using risk-free rate. Do you think this is correct? Correct. The present value of certainty adjusted year 1 cash flow is approx 41667. So 4.5 into what is the factor? The 8%. So divided by 1.08. Which will be 416. This is also correct. If the certainty equivalent coefficient decreases, okay, the perceived project is considered lower. The perceived risk is considered lower. This is incorrect. If the certainty decreases, of course the risk will increase. So this is wrong. But how will the risk decrease? So 1, 2, 3, 4 are correct. A is the correct answer. A A renewable energy startup planned to establish a battery storage facility in a semi-urban region. During the feasibility stage, the management projected aggressive sales growth due to expected government incentives and estimated operating costs assuming stable raw material prices. However, midway through implementation, global lithium prices increased sharply. Skilled technicians demanded higher wages, and additionally, safety compliance expenses arose. The promoters also faced pressure from investors to continue funding despite the project cost exceeding the original estimate by 35%. The finance team suggested revising the assumptions and reassessing the project's risk tolerance before committing further capital. Considering principles generally followed in practical risk analysis, which of the following is correct? Conservative estimation of revenues helps reduce the probability of project distress. Do you think we should take conservative approach, that do not go on the higher side, go on the lower side? This is correct. Cost estimation should generally ignore contingencies. Wrong. We should take care of everything. So this is wrong. Volatility in commodity and imported input prices may require safety margins while estimating project cost. Correct. Next. Management may determine a funding cutoff point by a project depending upon its risk bearing capacity. Correct. Since revenues are uncertain, risk analysis recommends applying higher optimization to revenue projection in order to attract investors. Wrong. We are not talking about investors, we are talking about certainty. This is wrong. So A is the correct answer, since 2 and 5 are not correct. So this is all about our this unit. Let's move to the last unit now. Before we move to the last unit, I'll give you a break for 5 minutes. Take a break for 5 minutes and then come back so that we can continue with the last units. Then we will continue with the last units. I'll give you a break for 5 minutes. Just give me 1 minute. I will open the 12th unit for you, and then we will continue with the last unit. This 5 minutes break I will give you. So we will start with unit 12, which is again very important. I have marked it as 5 stars, but I will give you a 5 minutes break. Let's take a 5 minutes break, you all. Okay, we are going to start with this unit now. I hope you all are back. Okay. So decision making, first of all, understand one chart that I gave you earlier, and I told you that this will be used everywhere. Same, I'm going to use it here. Sales minus variable cost gives you the contribution, minus fixed cost gives you profit or earnings, right? Now, understand. Cost affecting my decisions are known as relevant costs. These are considered in any sort of analysis. While costs which are not affecting my decisions are known as irrelevant costs. For example, if I have my decision is based on contribution, so fixed cost will be my irrelevant cost, and variable cost and sales will be my relevant costs. Uh, Cost will be my relevant cost, variable cost, right? Then you have sunk cost, past cost, which is already incurred, and now I will just ignore it. For example, you purchase a machinery for 10 lakh rupees. Decision today are going to ignore such purchases because you already have it in your possession. Then you have is opportunity cost. When you have multiple outcomes available or multiple options with you, so when you choose one and let go others, so the price, the cost of letting go is known as opportunity cost. So what is the benefit that I have sacrificed in order to choose my another alternative? So this is my opportunity cost. Then you have marginal costing concepts. Same I told you, just follow only this chart and nobody can touch you now. So contribution is equal to sales minus variable cost. What is break even point? Break even point is when I have no profit, no loss. Basically, I want to make my this value as zero. This value as zero. So it is highly dependent on your fixed cost. So it is highly dependent on your fixed cost. So it is your fixed cost divided by sales minus variable cost, also known as fixed cost divided by your contribution. So this can be zero only if contribution is equals to fixed cost, right? If contribution is 10 lakhs and fixed cost is also 10 lakhs, then only this level will be zero. So what we are trying to achieve is we are trying to achieve a point where your contribution is equals to your fixed cost. Margin of safety. Now what is margin of safety? Now if this is my sales, this is my break even point. Till here, till this unit, till this point, there was zero profit, zero loss, right? Now anything above, now this is your actual sale and this is BOP. Anything above anything between margin BOP, break even point and actual sales is your margin of safety. It is your margin of safety, which is actual sales minus break even sales. Higher margin safety, lower risk. Higher the margin of safety, lower the risk. Hunting. Okay. Then you have important decision for yourself, that is make or buy decision. Accept the option with lower relevant cost. If the making is coming at a lower relevant cost, then make it yourself. And if buying is getting you lower relevant cost, then you should buy it from outside. Then you have shutdown decision. When do I shut down my operations? See, continue operations if contribution covers your fixed cost. If your contribution is covering your fixed cost, equal contribution is more than equal to fixed cost, then you should continue with the operation. Otherwise, then shut down. Question number 1. Consumer electronic company plan to launch a smart kitchen device in a highly competitive urban market. The management estimated that initial production volumes remain low for the first year, resulting in a high cost per year, per unit. To attract customers, the company decided to keep the selling prices moderate, despite increased cost of imported components and digital marketing campaigns. Simultaneously, the board approved installation of an eco-friendly waste treatment facility, even though it would not directly increase the profits. During the second quarter, an unexpected flood disrupted the logistics and increased transportation expenses, forcing the management to revisit its pricing and production strategy. Based on the concept of CVP and financial decision making, which of the following statements are correct? CVP analysis: sales minus variable cost will give you contribution, which will, if you further subtract fixed cost, it will give you uh, profits. This is nothing but CVP only. This is CVP, cost variable cost volume profit analysis. Okay, CVP recognizes that change in fixed cost may alter the break even point even if selling price remain unchanged. So any sort of fixed cost will determine your BEP. Do you think this is correct? Do you think this is correct, that your BEP is highly dependent on your fixed cost? Yes, yes. If my fixed cost is equal to my contribution, then I have achieved break even point. So this is correct. This is correct. A business may take certain investment decisions on environmental or societal consideration despite weak economics. Correct. This is also correct. We do have to do certain things for the society. Next, increasing production volumes always reduces total fixed cost incurred by organization. How can production volumes will increase my fixed cost? Fixed cost is like rent. Now, if I produce 8,000 units or 10,000 units, my fixed cost will be same. How will the production units determine my fixed cost? So this is irrelevant. This is incorrect. Uncontrollable external events such as pandemic or flood may require reassessment of project viability and profitability. Correct. Higher selling price generally delays the break-even point. When all other variables remain constant, this is incorrect. Higher the selling price, better you will get it earlier. The break-even will be achieved earlier. So this is incorrect. So 3 and 5 are incorrect. So A is the correct answer. A is the correct answer. Next, a manufacturing company produces electric control units used in commercial vehicles. Is there any doubt with anybody? Please ask me. Before I move further, if there is any sort of doubt, you can ask. Okay. A manufacturing company produces electric control units used in commercial vehicles. The company is evaluating the financial feasibility of a newly designed premium controller. The following estimates are available for the first year of operations: installed capacity, expected sales volume, selling price, variable selling expenses per unit, annual fixed manufacturing overhead, annual fixed administrative and marketing expense, additional advertisements, interest on long-term borrowings, and corporate taxes. Management is considering a reduction of selling price by 10%. Okay, so the selling price is to be reduced by 10%. It is estimated that such reduction will increase the sales volume by 20%. So plus 20%. Okay. Fixed cost will remain unchanged based on the above information. Which of the following option is correct? The original profit volume ratio is more than 38%. So let's calculate it. The original values and the new values. Both the things we can calculate. Installed capacity is 1.2 and expected sales is 75% of 1.2, which is 90,000, right? Let's say original and changed. So sales volume is 1.2 75%, which is how much? Which is 90,000 units, right? Okay. Now 90,000 units will be sold. What is your sales price? It is 4,800. What is your variable cost? Manufacturing and selling, both the things we will take. 2,650 is your manufacturing cost, and variable selling price will be 5% of 4,800, which is 240, right? So total will be 2,650 plus 240, which is 2,890. 2,890. So it will be how much? Contribution will be 1,910. Right? Any doubt till here? Please ask. Okay. So 1,910 is your contribution. So PV ratio will be how much? Profit upon sales into 100. Contribution upon sales into 100. Your PV ratio. Now your PV ratio is contribution upon sales into 100. So 1,910 divided by 4,800 into 100, which is 39.79%. So this is correct. It is 39% approx, which is more than 38%. So this is correct. The original break-even sales quantity exceeds 70,000 units. So I know for BEP, the manufacturing cost, fixed cost I have to take into account. So manufacturing quote is 8.4 and fixed administrative is 5.1. And advertisement is also 1.5. So total fixed cost is 8.4 plus 5.1, which is 13.5 plus 1.5, which will be 15, right? 15 CR. So BEP units will be 15 CR divided by 1,910. 15 CR divided by 1,910 is your BEP. Unit wise, amount wise, you could have taken the amounts, right? So which will be how much? Which will be 78,000. So yes, it will exceed 70,000. So this is also correct. This is also correct. Spin number 2 is correct. After reduction in selling price, the contribution per unit will decline by 20%. Okay. Let's see. They are saying after reduction in selling price. So 4,800 minus 10%, which is 4,800 minus 10%, which will give you the revised selling price will be 4,320. 4,320. What is your variable cost? The variable cost is 5% into 4,320, because it is 5% of selling price, right? Variable selling price will be 5% of selling cost, which is 5% of 4,320, 216 plus 2,650, which will be how much? 2,866, right? So your new contribution will be how much? Your new contribution will be 1,454. This was the old contribution. This is the new contribution. So is the change more than 20%? देख लेते हैं. 1,910 minus 1,454 divided by 1,910. Original minus new divided by original. Always divide by original only. Only then you will have the correct answer. Which will be how much? 23.87. Yes, so it will be more than 20. Correct. Profit before tax after the proposed price reduction will increase compared to the original plan. How will the profits increase? There will be a loss now. My sales volume has decreased. My sales price has decreased. My expenses have increased. So they will be declined and they will not increase. So this is wrong. Margin of safety under the original plan is less than 15% of actual sales. So margin of safety is actual minus BEP. So what is the actual sales volume? Actual sales volume is 90,000 minus break even point volume is 78,500 something, which is 534. So your margin of safety will be 11,466 units. So your percentage will be 11,466 divided by 90,000 into 100. That is your percentage margin of safety. So yes, which is also 12% approx. It is less than 15, so this is also correct. This is also correct. So the correct answer will be D. Correct answer will be D. D is the correct answer. So yes, D is the correct answer. Next question. Any doubt, anybody till here? Please ask me if you have any doubt. Because these questions are very technical but very logical explanation that I have given you. If you work by that logical explanation, nothing can beat you. Nobody can beat you. If you have any doubt, please ask me. Okay, next. A manufacturing company producing industrial pump is facing intense competition and declining profits. The management is considering several alternatives, including outsourcing the maintenance department. Okay. Introducing a new low-cost product variant, accepting a bulk export order with a long credit period, and purchasing imported raw material at discounted prices. During discussion, one manager argued that the company should continue an unprofitable product line because significant advertising expenses had already been incurred. Another manager suggested that idle machine capacity could be used for an additional product without affecting existing production. The finance team was asked to analyze the proposal. Which of the following statements regarding relevant cost concepts is or are correct? Some costs are considered relevant if they were incurred specifically for the product under evaluation. There is a product which is under evaluation and some cost that which was previously incurred. Do you think they are relevant now? No. No. For current decisions, even if it is product related, this is sunk cost is sunk. We do not evaluate it again. So wrong. Opportunity cost may arise only when scarce resources have alternative uses. Correct. If there would have been alternative uses, then we would have taken care of opportunity cost. Avoidable costs differ between alternatives and are therefore relevant for decision making. Correct. This cost was avoidable, right? Acceptance of a special order should be evaluated only on the basis of immediate revenue. No, wrong. Wrong, not on immediate but on return condition, existing operation, customers, everything should be taken into account. Idle production capacity may eliminate opportunity cost in certain decisions. Correct. Correct. If there is any excess or idle capacity, additional production may not require sacrificing your existing output. Therefore, any sort of opportunity lost will be eliminated. Correct. So, the correct answer will be B. 2, 3 and 5 are correct. 1 and 4 are incorrect. Next. A company manufactures a component internally at a variable cost itna and fixed allocated overheads itna. A supplier has offered to supply the same component at 175 per unit. Okay. If the component is purchased externally, 40% of fixed overheads can be avoided. Okay. The company requires 10,000 units annually. The released capacity can alternatively be used to one contribution of 1,20,000 per year. Great. The relevant cost of manufacturing per year is 160. 140 plus 50 is your cost for this year, right? But avoidable will be 40% of 50, which is 20. So how much can you avoid? 40% of 50 can be avoided. So that is 20. So your relevant manufacturing cost will be 140 plus 20, which is 160. Right? So yes, one is correct. One is correct. Statement number 1 is correct. How did I find out that 140 is your variable cost? Plus I have to calculate the fixed cost. For fixed cost, it is 50, and they are saying that 40% are avoidable. 40% are avoidable, right? Avoidable fixed cost is 20. So relevant manufacturing cost is how much? 140 plus 20. So 160 is your answer. So this is correct. This is correct. Any doubt, anybody here? Please ask. If anybody has any doubt on this particular area, that why I have taken avoidable cost, you can ask me. And if it is clear, then I will move forward. Okay. Moving ahead. The avoidable fixed cost is 20. Yes, this is correct. We have just calculated. It is 20. The opportunity cost per unit of continuing internal production is 12 rupees. Let's calculate it. Let's calculate it, everybody, right? For internal production, opportunity contribution for alternative use is 1,20,000 divided by 10,000, that is 12 rupees per unit. Because if I do not produce it alternatively or internally, I would buy it. And if I will not make it internally, then I will buy it. And this machine that is now ideal will be used for getting a contribution of 1,20,000 rupees. And the capacity is how much? 10,000. So the opportunity cost will be how much? 120 divided by 10. 1,20,000 is my opportunity cost. If I do not make it internally, I will buy it. Okay? Divided by 10,000 is the units. So 12 rupees is the opportunity cost. 10 rupees is the opportunity cost. 12 rupees is the opportunity cost. Buying from the supplier will decrease the total annual cost by 30,000. My annual cost will be decreased by 30,000 rupees. Do you think this is correct? Do you think this is correct? See, the buyer is 175. If you buy it from outside, it is costing you 175 rupees. But if you make it on your own, if I make it on my own, it is 140 plus 20, that is avoidable, 160 total, right? Plus opportunity cost of 12 rupees. So this is what is costing me if I make it on my own. 172 if I make it on my own. But if I buy it, then 175. So buying is costlier for me, right? It is 3 rupees costlier to me. So buying from the supplier will decrease the total cost by 30,000. Do you think this is correct? Annual difference is 30,000. Yes, that is correct. That is 3 rupees into 10,000, 30,000. But buying is costlier. Thus, buys increases the 30,000, not decreases the 30,000. It will increase the 30,000. So this is incorrect. It will not decrease the 30,000. It will increase, because for making it, it is only 173. For buying it, I have to pay 175. For making it, I have to pay only 172. For buying it, I'll have to pay 175. So 3 rupees more costly. How will it decrease? So this is wrong. Internal manufacturing is financially preferable after considering opportunity cost. Do you think internal manufacturing is more preferable? Yes. Yes, correct. After I've seen that what is my opportunity cost, I know I have to internally manufacture it. I should not buy it externally. So D is the correct answer. D is the correct answer. Anybody has any doubt, please ask. If you have a doubt, please ask. Anybody, any doubt? This was a good question. Please mark it for revision. So for my making cost, what I'm doing is I'm considering my variable cost plus avoidable fixed cost. Always take avoidable fixed cost, right? Okay, next. Just give me 1 minute, everybody, please, and then I will be back. Okay, moving ahead. Yes, D was the correct answer. Manufacturing company recently noticed that although its overall sales have increased, the profit margins were declining. The management had traditionally allocated overhead on the basis of machine hours. However, an internal review revealed that certain customized products require frequent quality inspections, repeated material handling, and multiple purchase orders, while standard products required minimal support activities. The company is now evaluating whether a more activity oriented costing approach would improve pricing decision, outsourcing analysis, and customer profitability assessment. With reference to ABC, that is activity based costing, and related managerial decisions, examine the following statements. Under ABC, indirect costs are assigned to product on the basis of activities consuming resources rather than solely on production volumes. Do you think this is correct? Do you think this is correct? See, ABC actually tells you please allocate your overheads on the basis of activities and not on the basis of production. So yes, this is correct. Yes, this is correct. A cost pool in ABC represents grouping of cost associated with specific activity or process. 100% correct. A cost driver always measures only the number of units manufactured and cannot relate to making or research activities. Wrong. You take various aspects, not just production. ABC may assist management in identifying inefficient processes and improving operational transparency. Correct. In traditional costing approach, overhead allocation is generally linked closely with volume and measures the activity activity drivers. Correct. So only 3 was incorrect. So B is the correct answer. B is the correct answer. A furniture manufacturing company produces two products, Nova Desk and Prime Cabinets. The company incurs the following overheads for 1 month. Activity, total cost, driver and total driver units. Machine setup, total cost is this much, and the cost driver for is number of setups, and units are 120. Quality inspection, the total cost is this much, and the driver for it is inspection. Total driver units 900. Material handling is this much, and the cost driver for it is material movement, and the total driver units are 600. The following information relates to Nova Desk: number of setups, inspection hours, material involvement, units processed. The direct cost per unit of Nova Desk is 220. Okay. They have given you the total and they have given you one of the aspects. So we can find out for prime cabinets. Based on activity based, which of the following statements are correct? The setup cost allocated to Nova is 120. Let's calculate it. What setup cost 420. Number of setups are 30. Okay. Number of setups are 30. 480 is for the whole company. Number of drivers are 120. 480 divided by 120 into 30. This is for the whole company and 30 is for Nova. So how much will it be? How much will it be? Please calculate. 480 divided by 120 is 4000 setups. Yes. So inspection cost will be 36. Number of activity drivers is 480 divided by 120. Do you think this is correct? Yes, that is correct, which will give you 4000 per setup. Setup cost will be 30 into 4000, which is 120. So this is correct. This is correct. C. 120 is for the whole company. How much for one setup? 480 divided by 120. How much for 30 setups? 480 divided by 120 into 30. Simple. Basic unitary method. If someone did not get it, let me do it again for you. For 120 setups, you have to pay 4,80,000 rupees. How much will you pay for one setup? 4,80,000 divided by 120. How much will you pay for 30 setups? Because for Nova, it is only 30 setups. For 30 setups, you will pay 4,80,000 divided by 120 into 30. So, which is 120. So, yes, this is correct. This is correct. The inspection cost allocated to Nova is 72,000. So, inspection is 360. Total is 900. For 900 units, for 900 hours, you have to pay 360. For 1 hour, you will pay 360 upon 900. For 180, how much will you pay? So for 180, I will pay 3,60,000 divided by 900 into 180. Which will be how much? 400 per inspection. So 400 into 180, 72,000. It will be, this is correct. This is also correct. The material handling cost allocated is 36,000. Material handling total is 240 divided by 600 into for Nova it is 90 into 90. So it is 240 divided by 600 into 90, which is again 400 into 90, which is 36,000. 36,000. So this is also correct. So total material cost will be 120 plus 72 plus 36, which will be how much? Which will be 228. So this is also correct. Total overhead will be 228. The total cost per unit is 258. Okay, let's calculate that also. Per cost, I know 400 divided by 120 was how much? 480 divided by 120 was 4,400 and 400. This is 4,000 per unit. This is 400 per unit. And this is also 400 per unit. So total will be 4,000 plus 400 plus 400. That is 4,800. That is the total overhead. Right? Total cost is how much? 2,28,000. Oh, sorry. The total cost I know 228. And 6,000 units also I have total. They have given this also. So the total cost will be 228, which will be 38 rupees. So the total cost will be, so total will be how much? 220 plus 38. 220 they have given you. 38 I have calculated. So it is 258. So this is also correct. So 5 is, D is the correct answer. All are correct. D is the correct answer. All are correct. Any doubt, anybody, please ask. If you have any doubt, please ask. If you have any doubt, please ask right away. This was a good question, cause. Next. Manufacturing company facing declining margins due to rising raw material decided to reduce operational expenses. The finance head suggested delaying payments to small suppliers, reducing safety measures in the factory, and replacing permanent employees with temporary workers without proper benefit. Another senior executive argued that such action may improve short-term profits but could damage the employee trust, public reputation, and long-term sustainability. The board finally decided to review all alternatives using an ethical decision-making framework before implementing any cost-cutting measures. Which of the following statements relating to ethical and non-financial consideration in decision making are correct? Ethical decision making requires consideration of fairness, responsibility, and compassion, even when such decisions may reduce short-term profitability. Do you think this is correct? Yes, it is correct. Yes, it is correct. 100% correct. Even if we are suffering short-term profits, we should have ethical decision making. A decision may still be ethical, improper. A decision may still be ethically improper, even if it is legally permissible and financially beneficial. Correct. Ethically, it might be wrong, even if it is legally correct. Respectful treatment of employees, suppliers, and competitor contributes to organizational goodwill and long-term sustainability. Correct. Under the character-based decision-making model, determining facts and considering consequences are essential before choosing the alternative. Correct. Every action has a reaction, so see what will happen. The principle, everyone's doing it as regarded as a valid ethical justification. Wrong. Even if everybody is wrong, we cannot be doing it. So, yes, A is the correct answer. So, the most important formulas for module B I have given you at a place. Please revise them. The contribution is sales minus variable cost. DOL is contribution divided by EBIT. DFL is EBIT upon EOL. EBT. So, DCL will be DOL into DFL. Payback is investment upon annual inflows. ARR is average profit upon investment into 100. NPV is net profit present value minus investment. PI is present value inflow divided by investment. BEP is fixed cost upon contribution. Right? This is in units. For margin of safety, it will be actual sales minus BEP sales. So that is it from my side, everybody. That is the end of module B. I hope you all actually got a good insight for the whole volume. Now I will end my session out here and I'll meet you again for maybe some quick before exam revision. If you want any such explanation or revision, do let me know in the chat box. And for our paid batch, you can directly message us if you require any sort of assistance, and we are always here to help you. This is Radhika Dua signing off. Take care, everybody.